Welcome to Learn Commerce PU online classes. Don't forget to like our video and subscribe our YouTube channel for all the updates.
Hello students, welcome to Accountancy second PUC online classes. Students, in the previous class we have concluded financial statement analysis. That is, we have prepared comparative income statement, then comparative balance sheets, then we took up common size income statement and common size balance sheet, and we have concluded that chapter. Now I am going to take up a new chapter, that is accounting ratios or ratio analysis, right? Now friends, it is very important. Even the scores of the students in board exam, we take it as a percentage. What is your percentage? 90% plus, isn't it? 85% plus, distinction, first class, 60% above. So when we reduce it to percentage, it is very easy for us to know what is the performance of the student. If you ask the marks of a student in board exam, the student may say, in English I got 74, and in Hindi I got 68, isn't it? Or maybe in computer science or statistics I have scored 95, economics I have scored 98 maybe, business studies maybe 90, and accountancy maybe 99, isn't it? How you will conclude this? Can you get any information? That is, can you get a clear picture of the student now? No, it is not possible. When you add all those marks together of 6 subjects, and when you divide it by 6, you will get the percentage. Am I correct? You will get the percentage, and you can conclude that this student is distinction student, this student is 95 plus student, this student is first class student, isn't it? This you can conclude very easily. In the same way, when you prepare the statement of profit and loss and balance sheet, just by seeing the statement of profit and loss and balance sheet, it is not possible for anyone to conclude in a proper way. So what the management will do is, the management will prepare, that is for internal purposes, they will prepare different statements which are called, that is financial analysis statements, isn't it? Those include that is a common size statement, comparative statement, ratio analysis, trend percentages. All these are different tools and techniques that are available to evaluate the performance of the organization. They are called tools of financial statement analysis. Friends, in the examination they may ask you, mention any 2 tools of financial statement analysis, or mention any 1 tool of financial statement analysis, or they may give you dash is the financial statement tool, isn't it? They may give you 4 options. In that, 1 tool may be there, the other 3 may be irrelevant, isn't it? So like that, when we reduce the figures to smaller numbers, when we reduce the figures as comparison to between 2 different figures, then we can conclude more than what we see the balance sheet or statement of profit and loss and the information that we get. So for that reason, it is better to reduce the figures to, that is maybe common size, maybe 2 figures are compared, or ratio is taken by comparing 2 figures, or independent figures, or that is dependent variables, isn't it? So like that, that is analysis is called ratio analysis. Let us know the meaning of financial statement analysis first. I already took up, that is comparative balance sheet and comparative common, there's a statement of profit and loss, and common size balance sheet and statement of profit and loss, isn't it? But we didn't conclude actually what is the meaning of financial statement analysis. It is written here now. I will read out and I will explain what it is. Analysis, comparison and interpretation of financial statements by corporate sectors for taking decisions by external and internal users of accounting information is called financial statement analysis. Friends, here analysis means that is reducing to smaller numbers, isn't it? Or representing it in crores or millions, isn't it? Like that, that is analysis. Comparison, we compare one figure with that of the other. Maybe debt will be compared with the equity, debt equity ratio. We'll compare the debt with the equity and we'll come to know, or that is current assets and current liabilities will be compared and we'll come to know what is the current ratio. Or quick assets and current liabilities will be compared and we'll come to know what is the quick ratio, isn't it? In that way, we will compare the figures and interpretation of financial statements. Interpretation means reducing it to smaller size. That is the maybe 100 or 200 pages financial statements will be reduced to 1 or 2 pages, isn't it? The important information that is required by the management to take decisions. The figures, that is the financial statements, are analyzed or interpreted. Interpretation means preparing statements by taking the figures from financial statements and preparing different statements with the different purposes. For a particular purpose, we will take 2 or 3 figures from the financial statements and we will come to a conclusion while taking the decision, isn't it? Only the inventory will be seen, inventory figure will be seen, isn't it? We'll compare the inventory figure with that of the last year inventory figure. Then we will come to know what is revenue from operations, that will be compared, what is the stock, that will be checked, isn't it? So in that way, we will interpret the financial statements, that is interpretation of financial statements by corporate sectors, that is companies, for taking decisions by external and internal users. You know it very well, external users are the government, that is the competitors maybe, isn't it? The customers, suppliers, all these are external users of financial statements. Then internal users like employees, they want to know the performance of the organization because they are concerned about whether the salary or any other benefits, employee benefit expenses, isn't it? Whether that will be received by them properly or not. If the organization is very strong, financially very strong, then there is no headache, there is no tension for the employees to work there because they know that there is sufficient fund, the organization is strong enough economically and their that is a return will be guaranteed, isn't it? So for that reason, internal users like employees and the professional, that is people who are working in the organization, and the shareholders who are the owners of the organization, they are the internal users of accounting information. That is called financial statement analysis. So when we reduce the figures to smaller numbers or when we prepare special purpose statements by taking the figures from financial statements, either from the balance sheet or from the statement of profit and loss, and when we prepare different statements for internal and external users, that is called analysis of financial statements, analysis and interpretation of financial statements. Clear now? Yes. Now when we take up the ratio analysis or accounting ratios, then we should know the meaning of ratio. What is a ratio? A ratio is a mathematical relationship between two related items expressed in quantitative terms. A ratio is a mathematical relationship between two related items that must be related to each other. Debt and equity, debt equity ratio we can calculate. Current assets to current liabilities, current ratio. Quick assets to current liabilities, isn't it? Again, quick ratio or acid test ratio, that will come to know later. We'll take up one by one. There are different ratios here. So when we express it in mathematical relationship, isn't it? 2:1 or 2.5:1, like that, when we take up take up the analysis in the form of mathematical relationship between two related items or two related variables expressed in quantitative terms. Expressed in quantitative terms, not in qualitative terms. We cannot say that this is better than that, isn't it? You should quantify. We have sufficient, that is liquid assets. We have to quantify that. We cannot simply give a vague statement in case of accounts. While you take up any ratios or percentages in mathematical form, then it should be expressed in the form of quantity, not in the form of quality or any other explanation, isn't it? That is not required over there. So, when it is expressed in quantitative terms, it is called a ratio. Understood now? So, we will take the figures and we will express the mathematical, we will create mathematical relationship between the two related items. That is called a ratio. Now, moving on to the subject here, this topic here, concept here given, what is accounting ratio? Indicated quotients of two accounting numbers. Quotients means what? That is a square, isn't it? That is quotient. Or when we express it is to 1, isn't it? Or 1.5 is to 2. Like that, when we express in the form of, when we indicate in the form of quotients of two accounting numbers derived from financial statements, those numbers should be taken from the financial statements, that is expressed as a fraction. Fraction in the sense 1 by 2 is to 1 by 4, isn't it? That is fraction. Proportion 4 is to 3 or 1.5 is to 3, isn't it? That is proportion. And percentage 40%. Sales, isn't it? 40% increased, 10% increased, or 5% decreased. Gross profit ratio 50%, net profit ratio maybe 25%. That means the net profit earned is 25% of the total sales done during the current year. That is what is called percentage. And a number of times, isn't it? Number of time means stock turnover. How many times the stock has converted into cash and cash to stock, stock to cash, cash to stock, like that. Maybe 4 times, 6 times, 2 times, like that. We will express in the form of number of times, isn't it? How much marks Mr. A has scored compared to B? 2 times. Maybe B has scored 50 marks, isn't it? And Mr. A has scored 100, 10%, isn't it? So 2 times. When we represent it in the form of number of times, that is also coming under accounting ratio, is termed as, number of times is termed as accounting ratio. So whether you express in the form of fraction, in the form of proportion, in the form of percentage, or in the form of number of times, all these are nothing but accounting ratios. Clear? Yes. Now let us move on to what are the objectives of accounting ratios. Objectives of accounting ratios. Objectives of accounting ratios. I'll take up now. Yes. Objectives. Why there is a need to calculate accounting ratios? That is, what is the reason behind, or what is the rationale behind calculating accounting ratios? There are 4 points. Let me explain. To know areas of business which is weak and which needs more attention. When we calculate, that is when we take up the accounting ratios, when we calculate, take the figures from financial statements, and when we reduce it to percentage, fractions, number of times, like that, then we will come to know which area is very weak. That is, if the expenses, manufacturing expenses are more than whatever we have spent during last year per unit of output, or if the administrative expenses or selling and distribution expenses increased compared to last year, isn't it? Then we will come to know that that area is very weak, because expenses increased means that is a weak area where we need to concentrate more and we have to reduce the expenses. So that is one of the objectives. That the first one is to know areas of business which is weak and needs attention. Weak area, to find out weak areas of the business and to take remedial action, isn't it? What we will do? We will conduct examinations, isn't it? Then we will sort out who has scored good percentages and who have almost scored less than there is a passing percentage, isn't it? Then we will segregate them as remedial students, where we need to put more, that is attention. We have to concentrate more on them, otherwise they may fail. So in the same way, in case of corporate entities, whenever we analyze the performance of different departments or the organization as a whole, then we will find the weak areas so that we can repair that area, or we can make good that area so that our percentage of profit may increase during next year, or there will be progress of the company, isn't it? So that is called, that is one of the reasons why accounting ratios are to be calculated. Second one is to know potential area which can be improved. Which can be improved. The potential area which can be improved. That is a second objective. That is, we are seeing there is more demand in the market. We are not able, the total goods manufactured have been sold in the market. There is no closing stock, nil closing stock. And again, there are more number of orders booked by the organization. What do you think then? Then we have to improve or increase the capacity of production. Production capacity should be increased, either by, that is installing a sophisticated machine, or by buying one more new machine, isn't it? Like when online class starts, isn't it? If it is not possible to accommodate in one camera, one more camera is required. If two cameras are not required, two cameras are not sufficient, even after that we need to send more videos to the students, then we will buy one more camera, isn't it? But we have to make sure that whatever we do should not go as a waste. There should be some meaning. Whatever information we have collected and analyzed, the analysis must be correct. Then only we can think of progress, which can be improved. Such areas should be given more attention. That is another objective of ratio analysis, accounting ratios. Third one, to know profitability, liquidity and solvency. To know the solvency, liquidity, profitability and efficiency of the organization. Very simple, friends. What do you mean by solvency? When a person remains solvent, when you call a person as solvent and insolvent. Insolvent means the liabilities are more than the assets. The person is not in a position to pay off all his liabilities, isn't it? Suppose he has 1 crore bungalow with him and all other assets together, he has 1 crore worth. But his loan is 1 crore 50 lakh. Whether the person is in a position to repay all the debt, all the liabilities, even if he sells everything other than him, isn't it? He cannot be sold in the market. No one will buy an insolvent person. Whether anyone will buy? No. Whether anyone hires beggar? No, never. Isn't it? Whether banker gives loan to beggar? No, never. So like that, here my point is, solvency means ability of the organization to repay all its liabilities. All its liabilities. That is called solvency. Liquidity. Liquidity means the cash position. Ability to run the organization. Like if you buy an elephant, isn't it? You might have invested lakhs and crores to buy elephant. But after buying, you should feed the elephant every day. For that, you need to keep some, that is a liquid cash, isn't it, to buy those things. You are invested on machinery, plant, building, everything. Now, to buy raw materials and to pay for wages and other expenses, daily expenses, if you don't have cash in your business, do you think that is liquidity position? No. So, there must be liquidity because the day-to-day expenses are to be met. You should not come to such a position where you are supposed to close down the business for want of working capital. What is working capital? That is short-term funds, isn't it? Which are used for payment of short-term obligations. Short-term obligations. So here, like you have paid college fees, you took the admission, and you have no money to pay for the everyday, that's day-to-day bus charges, or for having food in the canteen, maybe, because students, they are very, that is happy to eat in canteen or outside food rather than at home. Mom prepares, isn't it, fresh food with all her efforts, and at last, especially in case of boys, isn't it, they never carry their tiffin box with them. They feel like it is a shame on them. My friends are not bring, why should I bring? Isn't it? They will say at home that I don't want this food, give me money. I want 20 or 50 rupees today. I want to eat in canteen. I want to have gobi Manchurian, isn't it? Or maybe buns. So this is the condition, friends. My point here is that is liquidity position must be maintained, otherwise what happens? You won't be in a position to attend the classes. If for these reasons, that is for giving money for food, pocket money, isn't it? Then for books and other stationery items, you need to pay because you have already admitted your child in a school. So if you simply pay the fees, it is not enough. You have to maintain the expense, day-to-day expenses of the student. So that is called liquidity position. The company or the organization must have sufficient amount of cash to pay for the day-to-day expenses of the business. Then profitability. Why business is run? When we start, why we start the business? To earn profit, isn't it? If there is no profitability at all, if the organization incurs loss, is there any need to continue the business? In the short run, it is okay, fine. You can, if you are able to cover at least variable costs. There are two types of costs, isn't it? Three types actually: fixed, variable, and semi-variable. So variable costs are if covered at least in the short run, that is enough. You can still sustain in the business, but in the long run, you must cover all the expenses, fixed, variable, and semi-variable. All the cost must be covered by you. Otherwise, you have one fine morning, you may have to close down the shutters of the business. That situation will come. For that reason, there must be sufficient profitability and the organization must be efficient enough. What is the efficiency of the management? How to calculate? By seeing the profitability, or by seeing that is a return given to the shareholders, the owners, in the form of dividend, isn't it? So all these matters a lot. So this is the third, that is objective behind accounting ratio. Then fourth one is to provide information to the management that helps in making projections and estimations for future. Estimation for future. So when we start a business, we cannot simply rely on the past figures, that is historical data. We must have all the information with us, isn't it? And on the basis of that, we have to make sure that in future, what we have to do, where to land, what should be our next goal, isn't it? Whether to expand the business, whether to open new branches, or whether to simply improving the quality of the product and sticking on to the same level of a business. All these things should be thought of. For that, accounting ratios are required to make estimations and forecasting about the future. What will happen in future, what we have to do in future, that is called forecasting. By taking all the that is risky factors into consideration, whether we can progress further, whether we can do some strategies, isn't it, to improve the business, whether we have to open new outlets, whether we have to open new branches, whether we have to that is introduce new sophisticated technology or the machine, isn't it, that we have to estimate. So these are the 4 objectives of accounting ratios. Now moving on to importance or advantages of ratio analysis. Advantages of ratio analysis. First one, helps in decision making. Merits or importance or significance, isn't it, of ratio analysis or accounting ratios. First one, helps in decision making. Of course, for taking decision we need accounting ratios. Without having genuine figure, we won't be in a position to take any decisions. So for that reason, we will collect information from the that is a final account, that is a statement of profit and loss and balance sheet, and then we will plan for the future. We will take decisions whether to pay this much of that is a dividend to shareholders, or whether we have to pay more dividend this year, or whether to whether we have to that is a stop paying dividend this year, isn't it? Because sometimes internally generated funds will be used for further expansion and all these things, isn't it? So we have to make sure that we will do that is we will collect information from the financial statements for future use or decision making. Second one is helps in financial forecasting and planning. That is, guides the management. Ratio analysis guides the management what to do, what not to do, isn't it? By taking different ratios, management will come to know what can be done, or whether to stop the business, whether to postpone this investment decision. All these things can be known. Helps in control. Helps in control. That is, when we take up different ratios, we will come to know which expense head should be controlled. If there is more expense for a particular that is a head, or one department is spending a lot, isn't it, then we have to make sure that we should put from some controlling measures on that department. Suppose waste is generated more in the production department, isn't it? We have to check the reason why the waste is generated more, and we have to take steps to reduce the waste, so that, because that can be done only when we get the proper information regarding the percentage of waste that is generated in the manufacturing field. Then next one is helps to calculate ratios and comparing with the estimated, that's a standard ratios, and deviations are identified. To compare with standard ratios, there are some standard ratios which must be there for a business, like current ratio 2:1 is the ideal ratio for an organization, but 2:1 current assets to current liabilities. If the current liabilities is 1, then current asset must be 2, isn't it? This is the ideal ratio for any business organization. This is the rule of thumb. We call it as rule of thumb. Rule of thumb. Rule of thumb, isn't it? So we have to make sure that whether our organization meets this limit, or whether we have more liabilities than assets. 1:1, isn't it, sometimes? But sometimes 1:1 is also good if the product is fast moving item. Fast moving item, then it is fine. That's liquidity ratio can be fine if we are getting cash every day by selling the product, isn't it? If it is manufacturing concern, you will not get money every day. Takes time to sell the goods, isn't it? In that case, you must have at least 2:1 ratio. That is a rule of thumb, which is standard ratio mentioned by it is the industrial norm. So this is another, that is advantage of ratio analysis. Then helps creditors by giving information, helps creditors. Creditors will come to know by seeing the financial statements whether we can supply on credit basis or not, isn't it? Because if there is guarantee of return, that is guarantee of it is a payment, then only they can provide credit. If the company is already incurring losses, who will give the credit? It's like giving loan to the beggar, isn't it, by the banks? Is it possible? Not possible. So in the same way, if the company is incurring huge losses, then the creditors may stop giving credit. So may stop extending the credit to the business. And this can be known only from the financial statements by the creditors. Helps the employees. Helps the employees, isn't it? Employees can get to know how much profit is earned by the organization and whether we can bargain for more wages or more salary or more incentives, more perquisites, isn't it? Whether we can demand for that, that can be known by the employees only by seeing the financial statement figures. So these are the 6, that is merits of accounting ratios. Now moving on to the dark side, that is limitations of ratio analysis. Ignores price level changes. Limitations, ignores. First one, demerits or that is limitations, ignores price level changes. Price level changes. That is, we analyze only the historical data. We are not concerned about the changes in the prices. The inventory at the beginning of the year will be calculated, the price will be quoted at whatever the price was there at that time. And after preparing the financial statements, maybe after 1.5 years, we will analyze those things. That is not, that is true. That is not correct, because price level may change. Maybe the price might have increased or decreased when we analyze the figures, isn't it? That is first problem. Second one is misleading information of financial statements. Misleading, that is, it will not give correct figures sometimes, because in accounting there are some concepts like we do, that is estimations, isn't it? We write the books of accounts, sometimes from estimations we will calculate depreciation, or unrecorded assets are taken at that is estimation, isn't it? So we will not get the exact figures from financial statements. So sometimes it may be misleading in case if the balance sheet is window dressed by the management, isn't it? Sometimes to please the creditors or to please the shareholders, the management may window dress the balance sheet. Window dressing of balance sheet means inflating the figures in the balance sheet. Reserves may be shown on the liabilities side and dummy asset may be shown on the asset side, isn't it? But actually that reserve is also not there, that dummy asset is also not there. Simply created in the balance sheet to make the balance sheet tally and to show the suppliers or the creditors and the financial institutions to rely on the organization, showing it as a stronger that is organization, isn't it? That is called window dressing the balance sheet. Then ignores qualitative or non-monetary concepts. Ignores non-monetary concepts or items, isn't it? Like I already told you in previous classes, that is quality of the managing director, good quality of the product, good reputation of the business, isn't it? Or honesty of a cashier, or special talent of the chief executive officer, isn't it? Whether it will be taken into consideration? No, it will not be reflected anywhere in the balance sheet or that is a financial statements. So that is another, that is a weakness of accounting ratio. Then variation in accounting practices. if the accounting practices, if we change year by year, then it is not possible for us to compare. That is a inter-period comparison is not possible, and even inter-firm comparison is also not possible, because the standard practice and procedures followed by us during current year may not be same compared to the other organizations, or whatever practices we followed during last year and current year cannot be compared. So we will not be in a position to come to a proper conclusion. That is another, that is a weakness, which is called accounting changes in the accounting practice. That is called the fourth weakness of accounting ratios. Last one is forecasting. Forecasting. When we depend on the figures that is taken from financial statements, and if we take the decision, may not be correct, because the figures taken may not be correct from financial statements. Financial statement figures may not be accurate, and if we take the wrong figure, and whatever forecasting we do, that will be wrong only. So we may land in trouble later. So that is another, that is a demerit of accounting ratios. Now, that is these are the limitations of accounting ratios. Now, let us know what are the limitations, the demerits of ratios. Demerits of ratios. These are the problems for the organization, isn't it? And this is there is problem with the ratio itself. So let us study those things. They are means and not an end. They are means and not an end. If we take one ratio and if we analyze it, it is not the permanent or complete solution for the problem. It may be a way to reach the goal, isn't it? We cannot say that this is the concluding one. So that is one of the weaknesses of ratios. Second one is lack of ability to resolve problem. Lack of ability to resolve problem. That is, we will come to know by seeing the ratio, we will come to know there is a problem. Whether the ratio will tell you what to do for that? No, ratio never says. It says the profit percentage, this year net profit 5%, last year it was 50%, isn't it? Whether the ratio will tell you what to do, what strategy you have to apply to resolve the problem? No, never. So that is another problem of the ratio. Third one is lack of standardized definition. No standardized definition. Like Nestle company was alleged, isn't it? That is some content is more in the that is Maggi noodles, whatever is prepared by them. Isn't it? There was a big issue. But what happened? Whether there was a standard definition that only this much content should be there in that food, otherwise it cannot be accepted, it cannot be used. Nothing was there. No standard definition was there, isn't it? It was not defined anywhere. Simply it was alleged that it is more. More means what? There should be something that 50%. If the content is more than 50%, then it cannot be used for human, that is consumption. It should not be, it is bad, isn't it? But no standard definition was there. So the allegation was dropped, isn't it? That was the condition. In the same way here, no standard definition for each of the ratios. How much should be there, how much should not be there. It is not there. So that is another weakness. Last one is lack of universally accepted standard levels or measurement. Universally accepted, that is a standard is not there. Standard is not there. That is, there should be international level, that is standard, isn't it, which should be accepted by all. If it is not there, then it is the ratio is useless. So then these are the various limitations of ratios. I will take up types of ratios and problems in the next class. Okay, we'll straight away move on to the problem part, and we'll try to solve all the problems of your question bank, so that there will not be any confusion for the students, right? Yes. Take down assignment. Mention the objectives. Mention the objectives of accounting ratios. Mention the objectives of accounting ratios, or mention the objectives of analyzing financial statements. Both are one and the same, right? Yes. Submit assignment on time. Thank you for watching this video. Thank you.
Don't forget to like our video and subscribe our YouTube channel for all the updates.